What if a potential economic shift in 2026 could create a unique window of opportunity for first-time homebuyers? And what if you missed it simply because you didn't see it coming? That's not just a hypothetical. There's a series of events on the horizon for the Federal Reserve that could trigger a drop in interest rates. And that might just turn an unaffordable mortgage payment into a dream come true. In this video, I'm going to break down what those events are and, more importantly, the 3 steps you need to take right now to be in the perfect position to take advantage of it. Let's be real. Trying to buy your first home these last few years has felt next to impossible. It's like you're playing a game that's rigged against you. Prices have stayed stubbornly high while interest rates shot up, pushing monthly payments into a different universe. So many people have had to pump the brakes on their dreams, watching their rent climb while home ownership just feels further and further away. As a mortgage advisor who's helped thousands of people get through this exact challenge, I see the frustration every single day. But I'm also seeing a potential shift on the horizon. While nobody can predict the future with 100% certainty, there's a lot of chatter among economists that the landscape in 2026 could look very different. Some are even calling this a potential housing market normalization. Not a crash, but a moment where things could finally start to move back in the buyer's favor. And it all hinges on a series of decisions made by the most powerful financial institution in the country, the Federal Reserve. Understanding what they're expected to do and when could be the key to your first home. Okay, percentages are one thing, but what does this actually mean for your bank account? This is where it gets interesting. Let's run the numbers. Imagine a hypothetical $400,000 home loan, which is a pretty common starting point for buyers across the country. For this example, let's assume mortgage rates are sitting at around 6.6%, a level seen in 2025. On a 30-year fixed loan, your monthly principal and interest payment would be about $2,557. Now, let's play out our scenario. The Fed makes its cuts and mortgage rates fall. Let's say they dip to 6%. That same $400,000 loan now has a monthly payment of around $2,398. That's a difference of $159 every single month. That's almost $2,000 a year back in your pocket. And over the 30-year life of the loan, that small 0.6% drop would save you over $57,000 in interest. That's a new car, a college fund, or a huge boost to your retirement savings. But here's the catch, and the reason you have to be ready. What happens when rates drop? Everyone who is sitting on the sidelines jumps back into the market. That surge in demand can quickly drive home prices up, wiping out the affordability you just gained. This creates that unique moment, a potential window where rates have fallen, but prices haven't had time to react and shoot back up. Being ready to act in that brief period is the entire strategy. Missing it isn't just about paying more. It could be the difference between getting a home and getting priced out all over again. If this is making sense to you and you want to stay on top of what's happening in the housing market, do me a quick favor and hit that subscribe button. My whole goal here is to give you clear, no fluff advice to help you finally make homeownership a reality. You can't time the market perfectly, but you can be perfectly prepared. If you wait until you see headlines that rates are dropping, you're already behind. The buyers who win in 2026 are the ones doing the work today. Here are the 3 things you need to be doing right now. Step 1, look like the perfect borrower on paper. When rates drop, lenders get flooded with applications. They're going to prioritize the people who are the most qualified. You need to be one of them. That means focusing on 2 key things, your credit score and your debt to income ratio. First, your credit score. This is the biggest factor in what interest rate you get. A higher score will literally save you thousands. Aim to get your score as high as you can, ideally 740 or above. How? It's simple, but it's not always easy. Pay every bill on time, keep your credit card balances low. A great rule of thumb is to use less than 30% of your credit limit. And don't go opening new credit cards or closing old accounts right before you apply. Lenders love to see stability. Second is your debt to income ratio, or DTI. It's just a fancy way of saying how much of your monthly income goes toward your debts, car payments, student loans, and so on. To a lender, a low DTI means you have plenty of breathing room to handle a mortgage. So start chipping away at high interest debts now. And please, do not go finance a new car or any other big purchase before you buy a house. Step 2, build your savings for the down payment and beyond. In real estate, cash gives you options. You might not need as much as you think, but you need to have your funds ready to go. Let's bust the biggest myth first. You do not need 20% down. While 20% helps you avoid private mortgage insurance, PMI, it's not required. There are great loan programs out there, like an FHA loan with as little as 3.5% down, and many conventional loans that allow 3% or 5% down for first-time buyers. The key is knowing your options. But the down payment isn't the only check you'll write. You also need to budget for closing costs. These are the fees for all the services that go into closing the deal, and they usually run about 3 to 5% of the loan amount. So on that $400,000 loan, you'd want to set aside another $12,000 to $20,000. Finally, lenders want to see that you'll have cash reserves left over after you close. They need to know you won't default if your water heater breaks in month 1. Having 2 to 6 months worth of your new house payment saved up is the gold standard. Step 3, get your team and your paperwork in order. When that window of opportunity opens, you have to move fast. That means having your people and your papers ready before you even start looking. Your secret weapon is a full, underwritten pre-approval. This isn't some 5-minute online quiz. A real pre-approval means a lender has dug into your finances, your income, assets, and credit, and has officially committed to lending you a certain amount. With that letter in your hand, you're as good as a cash buyer to a seller. It shows you're serious. To get it, you'll need your documents together. Start a house folder now. Gather your last 2 years of W-2s and tax returns, your last 30 days of pay stubs, and the last 2 months of statements from all your bank accounts. Having this ready means you can get pre-approved the moment you decide to act. And finally, start talking to real estate agents now. You want someone who really knows the neighborhood you're targeting, who gets the first-time buyer journey, and who has a plan for winning in a competitive market. The dream of owning your first home doesn't have to feel so far away. While there are no guarantees, the economic tea leaves for 2026 are pointing toward a potential opening for buyers who've been stuck on the sidelines. A period of lower interest rates could temporarily tip the affordability scale back in your favor. But remember, the real power isn't in trying to time the market. The power is in your preparation. By focusing today on your credit, your debt, and your savings, you're putting yourself in a position of strength. You're building a financial foundation that lets you act with confidence when the right house comes along at the right time for you, no matter what the headlines say. By following these steps, you won't be watching from the sidelines. You'll be ready, pre-approved, and empowered to finally turn the key to your first home. What's the single biggest thing holding you back from buying your first home right now? Drop it in the comments below. I'll do my best to answer every question. And if you're ready to get started on your journey, don't forget to like this video and subscribe for more tips to guide you every step of the way.